Have you ever wondered what strategies the most successful investors use to grow their wealth? The world of investing is vast and can be incredibly complex, with a multitude of strategies to choose from. Some investors might opt for an aggressive approach, taking on high risk for potentially high reward. Others might choose a more conservative path, prioritizing stability over explosive growth. But today, we're going to focus on a strategy that's particularly well-suited for those who prefer to play it safe, yet still want to see their wealth grow over time. This strategy is the general portfolio policy for the defensive investor. It's a balanced approach that combines safety and efficiency, designed to weather market fluctuations and deliver steady, long-term gains. It's not about getting rich quickly, but rather about growing your wealth sustainably and securely. Today, we delve into the general portfolio policy for the defensive investor, a strategy that has stood the test of time. Scene script. First things first, who exactly is a defensive investor? Imagine a calm sea captain, wisely steering his ship through stormy waters, always prioritizing the safety of his crew and cargo. That, in essence, is a defensive investor. They navigate the tumultuous seas of the financial market with a clear focus on preserving their capital and securing steady returns. A defensive investor can be likened to a tortoise in a race, slow and steady, always keeping to a path that minimizes risk. Their strategy is not about making quick, high-risk decisions in the hope of rapid financial gain. Instead, they appreciate the value of consistency and security. Key characteristics of a defensive investor include a conservative approach to investment. They typically opt for stable, blue-chip companies, bonds, or indexed funds. These are investments with a long history of steady returns, rather than new high-growth companies, which carry a greater risk. Another trait is their long-term perspective. A defensive investor is not swayed by the daily ups and downs of the market. They remain steadfast, understanding that the market's short-term volatility is less important than their long-term investment goals. Diversification is also a vital part of a defensive investor's strategy. They spread their investments across a range of assets and sectors, thereby reducing the risk associated with any single investment. This strategy aligns with the old adage, "Don't put all your eggs in one basket." Moreover, defensive investors are not typically day traders or speculators. They avoid complex financial instruments and speculative bets. Instead, they prefer simple, understandable investments that generate reliable income over time. Lastly, a defensive investor is patient and disciplined. They understand that wealth is built over time and that rushing into risky investments can lead to unnecessary losses. They stick to their plan, even when the market is booming and others are chasing the latest hot stock. In sum, a defensive investor is not in the game to hit home runs. They prefer to steadily accumulate runs over time. They prioritize safety and consistency over high-risk, high-reward strategies, understanding that the race is not always to the swift. A defensive investor seeks consistent returns and capital preservation, rather than chasing the next big thing. Now, let's delve into the general portfolio policy for the defensive investor. A defensive investor, remember, wants to play it safe. They want to see their money grow, but not at the expense of sleepless nights worrying about market volatility. So, what should be their general portfolio policy? Well, the first key element of the general portfolio policy for the defensive investor is diversification. This is the idea of not putting all your eggs in one basket. Instead, you spread your investments across different asset classes such as stocks, bonds, real estate, and so on. Diversification doesn't guarantee that you won't suffer losses, but it can help to reduce the impact of any one investment going sour. Now, you might be wondering, how diversified should my portfolio be? This brings us to the second element of the policy, known as the 50-50ths rule. This rule suggests splitting your portfolio equally between stocks and bonds. Why? Because stocks and bonds traditionally move in opposite directions. When stocks are doing well, bonds tend to do poorly, and vice versa. This counterbalance can help to smooth out the ups and downs of your portfolio's performance. However, it's important to note that the 50-50 rule is a guideline, not a strict rule. Depending on your personal circumstances and risk tolerance, you may decide to tweak this ratio. For example, if you're closer to retirement, you may want a higher proportion of bonds to reduce potential volatility. The third and final element of the general portfolio policy for the defensive investor is the emphasis on quality over quantity. It's not about owning a lot of different investments, but about owning the right ones. This means investing in companies that are financially stable, have a good track record, and are likely to continue to do well in the future. The same goes for bonds. You want to invest in bonds issued by reliable entities that are unlikely to default on their payments. One common mistake that defensive investors make is to chase the latest hot stock or trendy investment. But remember, as a defensive investor, your goal isn't to beat the market, but to achieve steady, reliable growth. It's better to invest in a boring company that consistently makes money than to gamble on a risky startup that could go either way. So there you have it, the general portfolio policy for the defensive investor in a nutshell. It involves diversification to spread risk, a balanced approach between stocks and bonds, and a focus on quality over quantity. These principles are designed to help you build a portfolio that can weather the ups and downs of the market, providing steady growth over the long term. By following this policy, a defensive investor can achieve steady growth while minimizing risk. But how does this policy work in the real world? Let's look at some real-world examples of successful defensive investors who have used the general portfolio policy. Take Warren Buffett, for instance. Known as the Oracle of Omaha, Buffett is one of the most successful investors in history. He's a prime example of a defensive investor, sticking to his principles and investing in companies that he understands and trusts. His company, Berkshire Hathaway, has consistently outperformed the market, proving the effectiveness of a defensive strategy. Buffett's philosophy is simple. Invest in businesses that you understand, and don't let market noise influence your decisions. He's known for his long-term investments in companies like Coca-Cola and American Express, businesses with proven track records and solid fundamentals. Despite the market's ups and downs, these investments have consistently provided steady returns over time. Another example is Benjamin Graham, known as the father of value investing. Just like Buffett, Graham was a firm believer in the principles of the general portfolio policy. He advocated for diversification, investing in stable companies, and holding on to investments for the long term. His book, The Intelligent Investor, has been a guide for countless investors over the years, demonstrating the timeless relevance of defensive investing. Through his investment firm, Graham-Newman Corporation, Graham achieved an annualized return of about 20% over 2 decades, surpassing the market average. His strategy was straightforward and defensive. Buy shares in undervalued companies and hold on to them for the long haul. Finally, let's consider John Bogle, the founder of Vanguard Group. Bogle championed index funds, a classic defensive investment. By creating a diverse portfolio that mimicked the overall market, he aimed to achieve consistent long-term gains. Today, Vanguard is one of the largest investment companies in the world, a testament to the power of defensive investing. These examples illustrate how the general portfolio policy has worked in the real world. Through patience and discipline, these investors have reaped the rewards of the general portfolio policy. They prove that defensive investing is not just a theory, but a strategy that can lead to real, tangible success. Through patience and discipline, these investors have reaped the rewards of the general portfolio policy. Let's recap what we've learned today. We delved into the world of defensive investing, a strategy that is all about preserving your capital while also earning consistent returns over time. It's not about making a quick buck or betting everything on a single stock. It's about playing the long game and doing so in a way that minimizes your risk. We've discovered that the general portfolio policy for the defensive investor is a roadmap to this kind of investing. It's a guide to help you navigate the often turbulent waters of the financial markets. It's about finding a balance, a middle ground between risk and reward. One of the key principles we've highlighted is diversification. This is the idea of not putting all your eggs in one basket. By spreading your investments across a range of sectors and asset classes, you can reduce the potential for catastrophic losses. It's about creating a portfolio that can withstand the ups and downs of the market. We also talked about the 50-50 rule. This is the concept of balancing your portfolio between equities and bonds. By doing this, you're able to take advantage of the potential growth offered by stocks while also having the stability of bonds to fall back on. It's another way to manage risk and ensure a steady flow of income. And let's not forget about the importance of focusing on quality investments. This means choosing stocks and bonds from companies and governments that have a proven track record of stability and growth. It's about investing in entities that are reliable and trustworthy, that aren't likely to suddenly collapse and take your money with them. These concepts may seem simple, but they are the foundation of a sound investment strategy. They are the pillars that can support your financial future, allowing you to build wealth slowly and steadily, without taking unnecessary risks. Remember, the key to successful investing is not about making the most money, but about preserving your capital and earning consistent returns over time.